Brokers. It's my pleasure to welcome to our webinar series Dan Sheridan of Sheridan Risk Management. Hey Dan, how are you?
I'm doing good, Jeff. How are you doing? Glad to be here today.
I'm doing great and appreciate you coming by.
Thanks.
So it looks like today we're going to talk about broken wing butterflies.
Yes, today is butterflies. I mean, some people might have exposure to them, some don't. So I'm going to kind of break down the difference between some different types of butterflies and hopefully give a little more information to those who are maybe a little familiar with them, and for people who aren't, explain a little more about them so that maybe you'll want to explore some more and go from there. So I'm excited about it. It's not everybody does them, but I think they're a pretty effective trade, and like anything else, Jeff, they're effective once you understand something a little bit better.
Exactly. And I just want to point out to our listeners, on the screen you should see the disclosure. If you could just take 30 seconds and read through that, please. And while you're reading that, just a couple questions that always come up. Is this recorded? Yes, it is. If you've signed up to attend this webinar, whether you're making it in live right now or something came up and you had to miss it, you're going to get an email toward the end of the day with a link with a recording of the webinar. And then also, even if you did not sign up for this webinar, and like all our other webinars, you can go on our website, interactivebrokers.com, go to education, and you can look for, if you go under webinars, past aired webinars. So you can always have access to all the great material that Dan presents, as well as our other contributors. And with that, then also for any questions, please just type them in the box. We'll get to them at the end of the presentation. And there's also a valuable handout in that same box where you can download that and use it as a resource and everything.
All right.
And on that, Dan, I will let you take it away.
Thanks so much. All right. So we're going to talk about the world of broken wing butterflies, introduce butterflies to you a little bit for some weekly income potential. So Jeff, you could go to the next slide. And so here's some of the questions that we're going to work through. So I may just bring up these questions, and then before I answer all of these, we might spend a little bit of time looking at a few pictures, just to give you an idea, what is this thing we're talking about? Because if I just go through all these questions now without looking at a graph, it may be a little harder to wrap your arms around it. So we're going to answer, what are broken wing butterflies? Why would you do them? Are these trades you might use for potential monthly income, and why? When to do these trades, up day or down day? Duration of these trades, calls or puts, excuse me for putting more of a golf word there, putts, but it's calls or puts, iron butterfly, VIX guidelines, and some other stuff. So hopefully we get through all of these, but let's start with a picture, and let's go from there. So we're going to start out, even though I said broken wing butterflies, this is a balanced butterfly. And so this is a balanced butterfly. I'll talk about it. This would be more for range bound trading. And so let's look at a balanced butterfly, and this generally is the cheapest butterfly. So we're going to sell 2 at the money calls, and you can look above there in the what we're doing, sell 2 NOV 21 6690 calls. So generally I'm selling at the money calls. Why? Because they have the most extrinsic value, right? That's where the juice is, the time premium, the extrinsic value, and those are the part of an option that decays the most. So that's really the reason to do this, is sell the at the money calls, right? So that's the whole purpose of this, is to sell that part of an option that decays the most. And that's the at the money call that has the most extrinsic value, the juice or premium. And we'll get more into it, but why would you, you're going to sell an option? Generally, we might do it when there's a little more premium in the options, maybe when the VIX or the option volatility is a little bit higher. right? When there's a little more premium in those. So, for example, just to give you something to wrap your arms around, if the normal VIX range for the last year is 12 to 22, 14 to 22, excluding the craziness of April. I'm not saying where we were when, the market goes crazy, but a normal VIX range of the last year, 14 to 22, maybe when the VIX is in the upper end of the range, 17, 18, 19, 20, I might consider a trade like this. I'm selling more extrinsic value. But here's the key. If you look in this case, I'm buying an in the money call, the 66.20, 70 points down, and I'm buying an out of the money call, the 67.60, 70 points up. So you say, Dan, what do you call this? I call it a balanced butterfly. What do you mean by balanced? Balanced is the in the money long strike 66.20 is 70 points from the short. The out of the money 67.60 is 70 points from the short, right? It's going for, in this case, a $6.70 debit. So if the world ends or SPX goes up 1,000,000 points, your risk is your debit, which is your margin, or your, when you do a trade at Interactive Brokers, it'll say your buying power, you used up $670 plus commissions. Generally, a balanced butterfly is about 25 to 30% cheaper than an unbalanced butterfly, which we'll talk about. But when you look at a balanced butterfly, one thing I'll let you know that's important to know is if you take your eyes and look to the left, you can see the date I put this on, or I looked at this example, Oct 22. So we were doing a Nov 21, about 30 days out. So Dan, would you normally do these maybe 3 weeks, 4 weeks out? Yeah, generally. Sometimes you could do it 2 weeks, but I would say more than that, I'll do these type of butterflies 3 weeks out. But what do you notice about this butterfly if you look at the Greeks? Delta say minus 1.5. What does that mean? How can that benefit your life or whatever? It's saying your deltas are short 150. So if that term bothers you, deltas of short 1.50, think in terms of stock equivalent, at least for a short move in the underlying. So if SPX went down 30 points, I'd expect to make around, just from the deltas, this is a quick and easy definition, 30 times 150 or $450, or $45, right? $30 down in SPX times 1.5, it'd be about $45, right? Just as if I was short 1.5 shares of a stock and it goes down, I'm gonna make money as we go down, right? If you're short 100 shares of stock and we go down $1, you lose $100. If you're long 100 shares of a stock, it goes up $1, you make 100. So think in terms of stock equivalent. So balanced butterflies are generally a little bit short delta. And just giving you a little bit of practical information. When do I normally do balanced butterflies? I'll start doing them when the VIX gets about 17 or I'd say about 18 or higher. Dan, why will you do these kind of balanced butterflies when VIX is 18 or higher? What's the reason? Well, think about it. If VIX is 18 or higher, 18, 19, or 20, which way is the market going? Generally, SPX. You're going down, right? Right? Generally, when VIX is rallying, right? VIX is 16, 17, 15, 16, 14, maybe 17. But when you start hitting 18, 19, 20, you're definitely getting more down days, right? We're finally going down. And when we start getting 18 or higher, I like doing these balanced butterflies. A little bit short delta, they do well on the downside. So I'm just giving you kind of, at this point, at least a little idea how we would use these things. But this is a balanced butterfly, right? And it's positive theta. You see the theta of 11 on the left-hand side. What does that mean? It just means that our short 66.90 will decay quicker than our long 66.20, which is in the money, and our 67.60, which is out of the money. So it'll produce, if we don't move too much, it'll produce some positive time decay. And over time, you'll make more. So that's a balanced butterfly. And again, it's centered around selling a lot of times options with more extrinsic value, buying options around it with less extrinsic value. And Jeff, why don't you, if you could go to the next slide. So remember what I said, right? I said balanced butterflies are normally short delta. Just the way they walk, the way they talk, right? So why would I do a broken wing? We call it unbalanced or broken wing. First, define, Dan, unbalanced butterfly or broken wing. Again, same short strike, 66.90. Same in the money long strike, 66.20, 70 points down. But if you look now, in the previous graph, I was buying a 67.60 call. So first question, what is a broken wing or unbalanced butterfly? It's where the distance from the short strike 66.90 to the in the money call 66.20 is 70 points. The distance from the short call 66.90 to the upper strike call 67.50 is 60. I would call this a 70-60, right? It's broken wing. Why? The distance from the 66.90 to 66.20 is 70. It's more than the distance from the short to the upper strike is 67.50. So you can call it unbalanced. You can call it broken wing. But if you said, Dan, what's the reason you do it? I do it to get the position deltas closer to zero, right? You can see the deltas there are 0.2. That's close to zero. But if you look at the graph, it reduces some of the risk on the upside, moves that a little bit to the downside. But you say, Dan, just like you mentioned, why you like, when you do these balanced butterflies in a higher vol environment because they're a little bit short delta, when do I like this type of 70-60, and the bigger number is always your width on the downside. When do I do these? Usually when VIX is 17 or lower. Why? If VIX is 17 or lower, 16, 15, 14, what is that telling you? You're having more up days in SPX than down. So the general trend is up. If you look at VIX 18, 19, 20, 21, which way is the VIX moving? Down. So if the VIX is moving up, I want to be closer to zero deltas, have a little bit less risk on the upside. Again, the debit spread before, Jeff, if you could just go a second, the slide before, that was $670. The 66.20, 66.90, 67.60. So you can see here, if Jeff goes to the next slide, now I'm paying $12, right? So do you pay more for a broken wing butterfly? Yes, right? What's the reason I would do a broken wing? To get the deltas closer to zero. In effect, it reduces my upside risk, increases my downside a little bit, but my capital requirement goes to about $1,220, the debit. And in the call butterflies that I've mentioned today, both of them, your risk is your debit, right? And you can see the Greeks along the left-hand side, theta, 7.5 per day, but that number will increase as we go towards expiration. And you have a vega of minus 35. And what does that mean? It just means that if the implied volatility, if the volatility of each of your three options goes down $1, you'd make $35 because, again, you're selling more extrinsic value when you're at the money 66.90. You're buying less extrinsic value in your longs. And again, you're selling two at the money. So these are two, you have a balanced, and then you have this thing unbalanced or broken wing. And again, if someone said to me, Dan, if I was going to learn a couple trades that kind of go together, what are kind of cousins? Two cousins would be the butterfly and the calendar. Why would they be cousins? Because they're both selling the at the money calls, right? They both have similar TP type graphs in the middle, There's some differences in them. The calendar, you would ultimately like the volatilities to move up a bit. In the butterflies, you would like the volatilities to move down a bit. So, but with this kind of 1-2 combo, you can do butterflies when the volatility is maybe in the upper end of the range and you think it can revert back to the mean. You would do calendars in the lower end of the volatility range, expecting them to go more up towards the mean. I mean, that's from a volatility point of view. But remember, more important than volatility considerations, if someone said to me, Dan, generally at these type of trades, are they generally, especially broken wing butterflies, would they be range bound trades? Yes. So more important than volatility, in my opinion, more important than anything is it's in the title, a calendar trade. A unbalanced broken wing butterfly, the way I'm setting it up at the money here, delta neutral, delta's pretty close to zero. They're range bound trades. So what does that mean? What do I need? What's the main requirement I need for a range bound trade? Some type of range bound activity, some type of two-way action, right? Like if you said to me, Dan, so number one thing I'm looking at is price action, right? I'm looking at the price action and saying, okay, is it two-way? Are we kind of range bound, which we've been? Dan, would you do a range bound? Yes, and I'll get to that in a second. And then, and I want a little bit of premium, maybe VIX 17, 18, 19 to do these butterflies, generally. Not that you can't do them when the volatility is lower, but the other thing is you notice on a day like today when we're doing the webinar, you've got a lot of catalysts on the table this week that can move the market. So I'm backing off a little bit on range-bound trades the last couple of days. Say, Dan, why are you backing off? What are the catalysts that could move the market? FOMC, I even looked to see what that has done. FOMC hasn't done anything yet. They're waiting for Chairman Powell to give his press conference. But we have, after the close tonight, we have Meta earnings, we have Google earnings, we have Microsoft earnings. Tomorrow after the close, we have Amazon earnings and Apple. I think Apple and Amazon. We got a lot of catalysts besides President Trump and the president of China speaking. So these are catalysts that can move the market. So even though if you said to me, so those are catalysts that can move the market. And let's be honest, if you look at since last Thursday or whatever, we've moved 200 points up in the SPX. Is that range bound? No. So you want to be aware of things like that as you're doing range bound trades, just like you're aware of Jeff or myself. If you go to the ocean with the grandkids or the kids, do you say, hey, the waves are 7 foot high. There looks like there's some sharks and some lightning. Maybe we'll go to an indoor activity today. So you always want to be aware when you're doing range-bound trades like broken wing butterflies at the money or calendars, they're range-bound. Make sure you look at the price chart, what's going on news-wise to make an educated decision. And also you're looking at volatility, right? If volatilities are lower, I may do the first cousin of the butterfly, the calendar. All right, Jeff, is that the slides, or we might have to go back to, okay. So let's go back to the one slide with all the guidelines. So folks, this is going to be recorded, right, this session. So you can go back and look that, maybe go back and study the two graphs so you can see the difference between balanced and unbalanced. And then you'll have an idea what they are, but then you could just use these guidelines as your, maybe for those of you who say, you know what, I may try and do some of these on paper and interactive brokers and get used to the strategy and get it in my bones a little bit. And then you could kind of couple that with the graphs and then my guidelines here. So what are broken wing butterflies? Again, the example I used would be sell the at the monies. And for an example, if you're looking at SPX, if you buy your in the money call 70 points down from where you sell the at the money, and maybe buying out of the money call 60 points up, right? That would be broken wing, that the distance from the short to the in the money call is different than the distance from the short to the out of the money. That's what makes them broken wing or unbalanced. If the distance on both sides is the same, that would be balanced. And again, it doesn't matter if you do calls or puts, right, on these things. Why do them? I do them for positive theta time decay trades, for potential weekly or monthly income. Are these trades for potential monthly income? Yes. Why? Because you're selling, again, the premise is you're selling the options with the most juice or premium or extrinsic value. Those are the parts and options that decay the most, and you're buying hedges or options around it that decay less. When to do these trades, up day or down day? Again, you can do these. I'm going to combine this with VIX guidelines. I would generally do, I'm looking at the VIX. If VIX is, starts getting 18 or higher, and we get an up day, I would plant that balanced butterfly, which is the first slide that was shown there. If VIX is 17, 16 or lower, mostly in the 16s or lower, that means the market's probably going up. I like that unbalanced one, right? And again, I'd rather do it on a down day, right? The unbalanced butterfly, I'd rather do the balanced on an up day. Execution and exit guidelines, there is no such thing as a mid price. There's a mid range. So I would watch the mid price for maybe a minute, get an idea where the price is trading the most occurrences. And since these are both debit transactions, I'd place it at the lower end of the range. So if you're watching it for a minute and you see $8, $8.20, $7.80, after the end of that minute, I've seen that's where all the occurrences are for the live mid prices. I'd go at the lower end of the, maybe a 780, go at the lower end of the range, 780, wait 20, 30 seconds, maybe cave in a nickel until I get to the upper end of the range, right? And if I don't get it, that's fine, right? But that's kind of an idea how you would do it. Always start paper trading first so you understand what you're doing. Risk management, profit target, and max loss. Generally, I won't get into adjustments right here, but I'll just say, so a lot of times on these trades, I'll use 10% profit target and maybe a max loss 15, right? So just to give you, as you're practicing this on paper, so if I paid $800 for one of these spreads, that's $800. If I paid an $8 debit and I wanted to make 10%, that'd be $80. So I buy it at $8, look to sell it at $8.80 credit. Max loss, you never want to, I think there's a very good win rate on these over time. And so, but the key is not losing that much more than you make. So if I'm making 10% profit target, and let's say I pay $8, 15% of $8 would be, or $8 debit would be like 120 bucks. So on $800, if I'm down 120 bucks, or we're kind of past the expiration break-even points, I'd get out, right? How many days to stay in the trade? Generally, these range-bound trades, the way I do them, I'm generally not in them more than 30% of the duration. So if it's a 20-day trade, in at about 6 days. So you're turning over your capital every week, right? If you're trading a $5,000 account, you're turning that over every week. And again, I think if you're a newer trader, even in SPX, you shouldn't be trading more than $500 trades, more than one or two of them. You should trade a small account, $2,500, $3,000, no more, and become a craftsman. If you're going to do a butterfly, you need to do one every week for 15, 20 weeks. Get used to it. Keep the dollar amount small until you know what you're doing. So, folks, that's a quick thumbnail of the broken wing butterflies. I would watch it another time, and then, but here's the key: watch it, go over it, and then practice it. Right? Practice it. But again, don't have this attitude, I'm going to give it a shot. You're going to put this on, commit for 5 or 10 weeks, or don't commit, or don't do it, right? Jeff, who's kind enough to help out and with the presentation today, Jeff traded many years as a market maker. And if I were to ask Jeff, I was traded many years at the Chicago Board Options Exchange. You know, you only get better at these trades as you do them over and over and over and over again. It's a craft. Wouldn't you say, Jeff? I'm bringing you in here.
Yeah, I agree without giving any kind of advice because I am not allowed to. But yeah, I agree, and I love the paper trading tool too, which I know Interactive Brokers, every account has it, and I'm sure other brokers do as well. But that is a like Dan said, that's a really great tool to get very comfortable with anything. And it's not real money, it's a paper trading account. So you can go and have that freedom to explore and get very comfortable and really learn by doing,
Yeah, and all of these trades, it's like all of these trades work over time if you know what you're doing, right? I mean, if Jeff, you don't know how to fly a plane, do you?
Nope.
I don't either. If Jeff and I went in a beautiful plane, mechanically perfect, we'd say, the plane stinks. And you say, Dan, why does it stink? I can't fly it. Well, of course. But if you put someone in there who understands it, they're fine, right? They can get the thing going, get it up in the air, whatever. And I think the same thing with whether it be butterflies or calendars. I mean, butterflies are pretty popular, but again, give it a shot. Right? But when I say give it a shot, I don't mean from a gambling sense. I mean practice the craft. This is a craft, right? People that I know and that I've taught, or anybody that is pretty good at butterflies, they've done a bunch of them, right? And you have to get used to it. You have to understand how they work. But I think this would be a good start for you. And again, one other thing, the example we had today on the balanced butterfly, that's the distance from the short to each of the longs is 70. If you're a beginner trader, instead of doing it 70 wide, make the distance from your short to your longs 40 wide or 50. You say, why, Dan? That'll put it in the $300 category or $400 category. So it'll reduce your risk. So even though SPX is a $6,000 vehicle, could you do 2 range-bound trades a month for probably $1,500 total or under? You could, right? Do I recommend that? Absolutely, right? Because, if you're a beginner trader and you're making money in range-bound trades because the market's not moving, that has nothing to do with you. Right? And sometimes you could feel like, oh, wow, I've discovered gold. And you start increasing your size and then you lose. So approach this like any other business. It's a craft. Learn these strategies. I gave you enough to be dangerous today, but please paper trade this 5, 6, 7 times before you even consider doing one contract of a butterfly, $500 or lower live at Interactive Brokers. So thank you, Jeff. If there's any other questions or anything, I'd be happy to.
Yeah, no, absolutely. This was great, Dan. So a couple of things. Again, a reminder to our listeners that they can get a copy of the slides. It's in the handout section. It's a PDF. They can just click on it and download it. But also, so let's see. Let me start with the first question. There was actually a few people, Dan, texted in very similar questions. Basically asking, I'll summarize them because there's like 4 people kind of asked the same question, but what's the advantage of the broken wing butterflies or even regular butterflies versus, two verticals, which would be the, iron condor, basically, they call it several different names, but essentially like, why this versus, condors or verticals, and is it,
Good
fair to
question.
consider these, high reward but low probability trades, I guess, which I don't think that's accurate, but,
No, yeah, so let's look at it. So let's look in the, when you look at an iron condor is selling an out of the money call and an out of the money put, and then you're buying your hedge or protection a little bit further out of the money. So an iron condor would be more of a higher probability trade, right? But depending on how you set it up, the risk reward generally would be stinky. I know that's not a good financial word, but it's stinky, right? It's not a great, and there's a, there's a saying, right? And I don't know where the saying came from, but you can't have your cake and eat it too, right? Yes, you can sell a strangle. That's an out of the money call and put, and buy your hedges further out of the money. That's an iron condor. And I like that. I think that's nice in a higher probability environment. And that's a positive theta short vega. You want the volatility to go down. When you're getting the world of butterflies, you're basically, in a sense, you're selling the at the money options. So you're going to get more theta than you would generally with an iron condor. And if you want to directly, I didn't talk about one type of butterfly today, but I will now, because when you're comparing with an iron condor. So again, iron condor, you're selling an out of the money call and put, buying your protection or hedges 5, 10, 20 points further out of the money. But in the world of, so I said a broken wing butterfly in the calls, broken wing butterfly in the puts, but there's one more butterfly that I didn't mention today, an iron butterfly, which would be more directly related to the iron condor, but it's the same graph as I talked about. So a broken wing butterfly would be at the money, where you're doing an iron butterfly would be using those same strikes that you see there, and thanks for bringing that up, Jeff, would be selling 166.90 call, selling 166.90 put. So if you're doing an iron butterfly, again, that would be related to an iron condor. I'm breaking up that sell 2, sell 166.90 call, sell 166.90 put. What's that called, folks? Instead of
That's a straddle. You're selling a straddle in the middle of it.
Yeah, whereas an iron condor, you're selling the out of the money call and put. The foundation of an iron condor is a short strangle. The foundation of a butterfly, especially an iron butterfly, is a short straddle. So you get more theta. You'll benefit more if theta goes down. An iron condor benefit more, volatility goes down, but it's more theta from it. So an iron butterfly, if I convert, just take these same strikes, same expiration, now make it a credit transaction. I could make it a credit transaction, but I'm going to sell the at the money call and put. But now watch this. I'll go buy the 66.20 below the market in the calls, but I'll buy the put. So I'll buy the 66.20 put. I'll sell the 66.90 put. That's a put credit spread, 70 wide. On the upside, I'll sell the 66.90 call, buy the 67.50 call, right? So an iron butterfly, it's the same graph as the call broken wing butterfly, the same graph as the puts. So what's the biggest difference between an iron butterfly, that would be the same strikes as I mentioned here today, and an iron condor? The iron butterfly, or the butterfly, you're focusing more the at the monies, selling the at the monies straddle. The iron condor, you're selling the strangle. So the iron condor would benefit quicker if the volatility went down. The butterfly is benefiting more on more daily theta. Why is it more daily theta? Because you're selling the at the money options, where that's the juiciest part of a option with the most extrinsic value. So I hope that was a long-winded story, but I hope that gave a little bit of help to explaining the differences.
Yeah, no, that was good, Dan. And we have Jim asking, what are suggestions for doing butterflies upside down from what's being shown? So eventually, basically reverse butterflies. You know, I guess really he's probably asking like what situations would you take the other side of this trade?
Yeah, well, that's a good point, right? You say, when wouldn't you do these types of butterflies? Well, again, since they're kind of in the realm of range bound, well, what if the market isn't range bound? So look, what if you thought like today when the Fed chair comes out, and there's some things that bothers the market one way or the market likes it, we can have a big move. There's a bigger expected move over the next 2 days because you have the FOMC and a lot of these big earnings coming out by the tech stocks, a lot of the Fab 7 or Magnificent 7, whatever they call it. But so I'm looking today, just give you an example. One of the trades we were going over today in class was more of a reverse iron condor, but you could do reverse iron butterfly. Reverse iron condor is the opposite of an iron condor. You buy an out of the money call and put, and then you sell options outside of that. And it'd be the same with a reverse iron butterfly. You would buy the at the money, buy an at the money call or put, that would be the straddle, and then sell some options outside of it. So what are conditions that I would do the opposite of an iron condor or butterfly? And it would be, when would I do it? When there's catalysts on the board that could move the market, number one, which there is the next 2 days, FOMC and the interest rate. So when there's catalysts that can move the market, number one, or we're in a situation like April where there's big candles, we are moving, right? Where you have candles, price candles where we're moving, a range of 70, 80 points, 60 points in the SPX every day, right? Right, versus, a very quiet market, the range in SPX candles between the high and the low might be 30, 40 points. So when would I do these type of reverse iron condor or butterfly? When I'm expecting movement, when there's catalysts coming out, news, or when we're already moving, or maybe when and again, an expectation when the volatilities are lower, but I'm looking maybe 30 days out, I'm expecting some volatility in the future, I would get into one of these positions. But again, there has to be a belief there's going to be some movement, right? Because a reverse iron condor, a reverse butterfly is negative theta. What does that mean? Time decay is going against you. Every day we don't move, you're losing money. And that can get a problem. That could become a problem. All right.
Yeah, we have another one. We have one from Coloco. And I know you mentioned earlier in the presentation, 3 to 4 weeks out, you would do your kind of recommendation or your idea on when to do these. But they're asking, how effective is this strategy with the 0, days to expirations, options on SPX or SPY? And I guess I would kind of maybe add on to that, like either side of it, would you ever use this for a shorter, a shorter term, either reverse or regular butterfly, iron or regular butterfly?
Yeah, that's a great question. And we do, again, I think it's, that's a great question because, yeah, the majority of the capital that we would put into butterflies or calendars would be maybe 15 to 30 days from expiration. That would be the majority of a higher capital. But, would we do trades, butterflies and iron condors and calendars 0 days, 1 day, 2 day, 3 day, that type of 4 day? Absolutely, right? But again, let's remember this, folks, the big picture here. The closer to expiration, your price risk goes up substantially, right? And so things move against you very quickly. in these butterflies and stuff. So the number one thing I can't overemphasize, if I'm doing a $4,000, let's say that's my size, doing a $4,000, 15 to 30 day butterfly, if you said to me, Dan, based on that $4,000, if that's your normal size for a butterfly or calendar trade, if you're doing 15 to 30 days out, what would you do if it was 0 day? For 0 day, I might do 10% of that, right? It might be a $400 trade, right? Smaller, right? Especially until you get very good at it. Why? Because when price moves against you on a 0 day trade, I'm going to give you a horrible analogy, Jeff, and nobody practiced this. If the price goes against you on a 0 day trade, it's like running across the expressway in rush hour, right? You're going to get clipped, right? It's too fast, right? But if you have a 25, 30 day butterfly, it's a little slower, price moves. It's like running across the highway at maybe 3 o'clock in the morning, not as much traffic. Jeff, that might be the worst analogy.
No.
Broke this webinar. But the point is, because of the increased price risk, and it can go against you quickly, reduce your size, right? Same as, when people do earnings trades, right? That we're in our last big earnings cycle of the year, October earnings cycle. So you have all these big, tonight after the close of trading, you have Meta, Microsoft, Google, tomorrow evening, Apple, Amazon. Well, in a way, they're crapshoot, right? It's going to move, right? They have expected moves on these things. And if it moves more than you expect to move, you could lose the whole thing. So how do you trade those things? You only trade with capital you're willing to lose. So those trades would be much smaller, right? So I don't know, what was the question again? I don't know if I got to that point. I was giving more of a preface of that whole thing.
Yeah, no, it was just whether and I kind of expanded on it, but whether a butterfly or reverse butterfly, whether it's balanced or broken, would be in a something recommended for or something that could be used, I guess, for 0 days to expiration.
Oh yeah, both you can use. Whether it be both trades, right? Whether it be a butterfly or the opposite of a butterfly, whether it be an iron condor or the reverse. I've done both. I mean, we'll do butterflies on a regular basis, but again, smaller capital, but sometimes I'll be a little more subjective, right? If I'll look like in the morning, we'll do a butterfly in the morning, but we're looking for, okay, no news, is the range, maybe let the market breathe a little bit the first hour, look at the range. If there's less than a 30, 40 point range, you put it on and might stay in it for no more than a half hour. So it's a different animal, right? There's a different set of rules or a different animal than trading a 0 day or a 2 day trade than a 15 to 30 day. The Greeks are different, everything's different, but yes, I think they're great trades as you understand them, but I think sizing, I'll just say this, sizing is real important, right? When you're sizing, and the more risk on a trade, the less sizing, right? And as you get closer to expiration, I just think with 0 day, I think they're a great product, right? But I think it's understanding them and how do you trade them and learning to trade them a little bit. But yes.
And is there anyone else out there that has any other questions? Oh wait, we got one here from Edward. Is asking, what are the circumstances where you could create a risk-free butterfly? I just know it is an adjustment you can make where the total risk is equal to the premium collected.
Yeah, I don't know. I mean, I'd be happy if you sent Dan at SheridanRiskManagement.com. If you sent me that question, I'd be happy to answer any questions. If you had specific on that, I'd be happy to. But when anybody tells you risk, if you could do, there's no risk, risk-free adjustment. It may be in a certain, but there's no Yeah, I want to say this without knowing what it is, so I'll hold my, but my first thought is there is no risk-free adjustment, right? It's taken in context, right? I mean, there's you can reduce your risk or whatever, but anytime you make an adjustment to a trade or something, right, you're creating more risk, right? Yeah, but I'd be happy to answer that, but I don't believe in risk-free. I mean, think about it, Jeff. You've been a trader for a long time. I was a trader. If I could do risk-free, but here's the key: risk-free adjustment. But if I'm going to keep the trade on, can I lose more money? Right?
Right.
Right. So there's no free lunch here, right? But I'd be happy if you send me that specific. If you send me an example of something, I'd be happy to take a shot at answering it.
Yeah, and if you could just repeat that email address, Dan, for our listeners.
Yeah, Dan at SheridanRiskManagement.com.
Perfect. All right, I think we are good for today then, Dan. This was great. Once again, for our listeners, you'll be sent a recording of this later in the day. Also, all of Dan's past webinars, as well as our other contributors, are on our website. If you go to education and under previously aired, you can grab them. And until next time, Dan, thank you once again.
All right, take care, Jeff. We'll see everybody later. Thanks.
Yep, have a good one.
Thanks.